If you've looked at the headlines in the last 48 hours, you'd think the sky was falling. From the hantavirus to the wars in the Middle East and the price of oil, it's the triple threat of global drama. And the mainstream media, they're eating it up. In this video, I'm going to share with you why I believe this summer is going to be a breakout season. And it's all because of data that I've found that's coming direct from the consumer. Stay tuned. You don't want to miss this. Welcome to Patterns and Profits. I'm Tom Gentile, America's #1 pattern trader, here to help you navigate these markets, not with day trading or meme trading, but with direct driven pattern trading. Make sure to hit that like and subscribe button and notification bell so you can get these videos as soon as they're released. First, the medical front. The World Health Organization is tracking a deadly hantavirus cluster, the Andes strain, linked to cruise ship travel that has everyone looking over their shoulder. In the Middle East, the U.S.-Iran war of words has turned into a maritime blockade, with Tehran threatening to, guess what, shut down the Strait of Hormuz again, and President Trump is calling their counter proposals totally unacceptable. Meanwhile, not far away, the Israeli-Lebanon border is seeing a massive surge in Hezbollah drone strikes, the highest that we've seen since the April ceasefire. Take a look at all this. On paper, it looks like a recipe for a market meltdown. Traditional wisdom says that high oil prices and regional wars should be tanking your portfolio right now. But the S&P 500, well, it just hit another all-time high today. Despite the headlines, the market is essentially yawning at the tail risk scenarios we're seeing right now. And I have one ETF that tells the story of typically what happens when we head into summer, regardless of what's happening on the world stage. The majority of exchange-traded funds, these are ETFs, are now bullish. So let's take a look at the top three that are on my screen right now. You've got the S&P 500 ETF, which is SPY, the IWM, which is the Russell ETF, and XLY. They've all moved higher in the last 10 years between now through the month of July, with average price moves of about 6 to 7% in this time frame. Now, you may have heard of SPY, you may have heard of IWM, but many of you may not know what XLY is. XLY is the Consumer Discretionary Select Spider Fund that tracks the consumer discretionary sector in the S&P 500. So it tracks a slice of the S&P 500 stocks, including retail, e-commerce, restaurants, automobiles, and some larger holding names like Amazon, Tesla, and McDonald's. Now, XLY often performs well when the economy is expanding, employment is strong, and interest rates are falling or stable. So let's pivot to the last decade. So looking at now through July 30th, XLY has moved higher in each of the last 10 years by an average of about 7%. The worst year you see was 2017, just a 1% move up, and the best year, 2023, with a better than 16% move on the year following the bear market. Now, there's no guarantee this pattern is going to repeat itself, but seasonal patterns are what I trade. It's what I do. And so let's turn our attention to the current price chart of XLY. Looking at the screen, since the bear market of 2022, XLY has climbed from $70 a share to $120 a share, but it's been hanging out in this area now for about a year. The technicals, however, are poised for a breakout. So, forget mainstream media and the clickbait that comes with it. The consumer is telling the real story here, and ETFs like XLY tend to follow the pack. And the pack, well, it's heading north right now. So, what do you think? Let me know your comments below. Thanks for watching, and I'll see you on the next one.